This is also called principal agent relationship. Okay, another way to learn this is principal agent relationship. Suppose I have a partnership with X, Y and Z as partners. Okay, X, Y, Z are partners carrying on a partnership business. Suppose Z goes to a company, say ABC Limited. Okay, Z goes to a company ABC Limited and he enters into a contract. Okay, suppose XYZ are in the business of buying and selling some iron and steel goods. Okay, and Z goes to a company which is ABC Limited and Z enters into a contract for the sale of these goods. So the company agrees to buy the goods. So for the terms and conditions, Z enters into a contract. Now when Z enters into a contract, does he enter into the contract in his own behalf or does he do it on behalf of the partnership firm? Definitely he is doing it on behalf of the partnership firm. He is representing the partnership firm and he is representing all the partners of the firm. So therefore it is a contract which is entered into not by Z but by the partnership firm itself. So that is called principal and agent relationship. Partners are only agents. Okay, so this has to be first understood. Now notice here I have only said that they have agreed to share the profits. They have agreed to share the profits and I have not mentioned the word loss here. Okay, so you can never by mistake also please don't include the word losses in the definition. But that does not mean that the partners will not share the losses. Definitely they will share the losses also. But what we are trying to say is the intention of the partnership formation itself cannot be for sharing the losses. The intention of the partnership should only be to share the profit, and if it is to share the losses, then it can never be a partnership firm. Okay, so make a note here. The intention of partnership is only to share profits. Okay, intention, partnership can be formed only if the intention is to earn profits. Okay, now the intention of the, so what is the type of company or the type of entity where the intention is to share the losses? So there are certain entities who do not function for profits principally. Prima facie they are there to serve the society. For example, non-profit organization. Okay, if there is a non-profit form of organization, these are there to serve the society. Okay, and this is not to earn profit. So here the intention of an NPO is not to earn profit but to serve society. So can an NPO be formed as a partnership firm then? No, it cannot be formed as a partnership firm because the intention of a partnership firm is to share only the profits, is only to share the profit. So NPO cannot be formed as a partnership firm. NPO cannot be formed as a partnership firm. Now, the next section I'll move on to is, when you say fundamentals of partnership, when I talk about fundamentals, that implies I will be learning how to do accounting for partnership, accounting basic rules for a partnership firm. This is what I'll be studying. I need to know how to do the accounting for the partnership. So let me take one example. Okay, I have three people, X, Y and Z. Okay, they form a partnership firm and they will definitely have an understanding of how to share the profits, in what proportion to share the profits, what happens in case of a loss. Okay, and who brings how much capital, how does the capital contribution work, So many different aspects are there which need to be decided before entering into the partnership. Logically speaking, when you enter into any business or a profession, you would definitely put down the various conditions for our understanding. So you and your partners, in the case of a partnership firm, XYZ in that case, they would get all the rules, of the partnership into an understanding which is called as the agreement or a partnership deed. This document or this understanding itself is called agreement or a partnership deed. They can also say just deed. Okay, deed means partnership deed in the context of partnership firm. Now the unique point here, the unique concept is that the agreement or a partnership deed that we are having here can be either oral or it can be a written form also. It can be oral or it can be written. Okay, this is an exam question, so please make a note here. You can get tested in the exam. They will ask you whether the agreement can be oral or it has to be only written. So in earlier days, maybe nowadays we have everything in written, but maybe in the initial period people might go into oral agreement. So these days still we have written, but the question is that the answer is that both are possible. Agreement or partnership deed can be either oral or written. Please be very careful. Now, so if that is there, then you will put down all the concepts, whatever can be the complications which can arise in case of insolvency. What happens if a new partner is admitted into the partnership firm? What happens if an existing partner retires from the firm? What happens if a partner dies during the tenure of the partnership? So all these situations would be already contemplated and put down in the form of an agreement. It can be an understanding which is oral or it can be written agreement also. Okay, now the next portion is what happens in the absence of deed? What happens in the absence of a partnership deed? So if the agreement or partnership deed is there, then we can follow it. Okay, suppose we have a situation where the terms and conditions are not decided between the partners. Suppose the partners do not have any understanding with regard to terms and conditions. Suppose they don't know the ratio, they don't have the capital contribution ratio, they don't know what to do in case of admission of a partner. In that case, what happens? So if you don't have any such set of terms and conditions, then what will happen is you have to follow what is called the Partnership Act 1932. This act, which is called Partnership Act 1932, has to be followed in case if the terms and conditions are not decided between the partners. Okay, understood? So if the terms and conditions are decided, it can be either oral or written, we follow that, well and good. If the terms and conditions are not decided, then you have to follow the Partnership Act of 1932. Okay, we have learned the mutual agency principle. And then what is the intention of a partnership? It is to share only the profits. Okay, it is formed with the intention of only sharing profits. And the next thing we have learned is what happens in case the partnership is formed. There is something called agreement or partnership deed. It can be oral or written. And then we said that if the terms and conditions are not decided or agreed between the partners, then you have to follow the Partnership Act 1932. So in the coming chapter, we would be also studying what is there in the Partnership Act 1932 with regards to basic concepts like profit sharing, capital, admission, etc. etc. So we will be going in for the next chapter, next section of the chapter with regard to all these concepts. So we'll first begin with the concept of profit sharing, okay, for a partnership firm. Now, if there is an understanding that the profits will be shared in a specific ratio, then there is no complication. You would share the profit of that firm in the specific ratio mentioned in the question and you would go ahead. Okay. But if there is no ratio mentioned, if they say that the partners have not agreed on any ratio for profit sharing, then what to do? So in that case, in a practical scenario, what happens is if there is no ratio agreed, if there is no deed or there is no ratio agreed, note down, in the absence of a partnership deed, profits will be shared equally equally between the partners. And make a note within brackets here. Irrespective of capital contribution. Now this is mentioned in the Partnership Act 1932. Okay, so what they're saying here is, in the absence of a partnership deed, the profits will be shared equally between the partners, irrespective of capital contribution. Now please understand that any legislature, now law or accounting is heavily based on the acts, okay, on various acts. Now the Partnership Act 1932 is an important act which defines our accounting in the case of a partnership firm. Now any act is divided into various sections, like you have 1, 2, 3, etc. Now in the case of a Partnership Act also, there is something called Section 13. Section 13 of the Partnership Act stipulates that in the absence of a partnership deed, the profits will be shared equally. So this section stipulates that profits will be shared equally between the partners, irrespective of capital contribution. Therefore, in the absence of a partnership deed, you would have to divide the profits equally between the partners. Okay, please make a note of this and remember this, and let us go in for an example now to help us to understand better. Okay, A, B and C are partners with capital of rupees 1,50,000 by A, rupees 50,000 by B and rupees 25,000 by C. All the partners decided to share the profits in capital contribution ratio. Decided to share the profits in capital contribution ratio. However, there is no partnership deed among the partners. Okay, so now they say that ABC are partners with capital of 1,50,000 by A, 50,000 by B and 25,000 by C. All the partners decided to share the profits in capital contribution ratio. However, there is no partnership deed among the partners. Now come to the concept which I have taught in this first para. In the absence of a partnership deed, it says absence of a partnership deed, profits will be shared equally between the partners. So the solution for this is that in the absence of partnership deed, profit will be shared equally between the partners as per section 13 of Partnership Act 1932, irrespective of capital contribution. Matter who contributes how much money, how much capital. If there is no deed, it does not matter. If there is no deed, then you have to divide the profit in the equal ratio amongst the partners. Okay, so now let's go on to one question. If there is a deed, then what happens? Okay, so make a note of this question. X, Y and Z are partners sharing profits in 5:3:2 as per partnership deed. During the year 2018-19, profits of the firm are rupees 1 lakh. Find share of X, Y and Z. Okay, X, Y, Z solution. X, Y, Z 5:3:2. Now, out of rupees, now one more thing. If you say 5:3:2, how do you divide the share? Okay, so first what you do is you have to add the three numbers. 5:3:2. You add, what do you get? We get 10. Suppose your profit is rupees 10. Okay, X gets 5 rupees, Y gets 3 rupees and Z gets 2 rupees. This is the explanation of the 5:3:2 ratio. Okay, I'm just giving one example of rupees. It's not really rupees. Just understand that out of 10 portions, X gets 5 portions, which is 1/2. Y gets 3 out of 10 portions and Z gets 2 out of 10. Okay, so now our profits are rupees 1 lakh. In this, X gets 1 lakh into 5/10. Y gets 1 lakh into 3/10 and Z gets 1 lakh into 2/10. That is equal to 50,000 for X, 30,000 for Y and 20,000 for Z. If I add all these up, I will get my profit total 1 lakh. Okay, so the share of X, Y and Z is rupees 50,000, rupees 30,000 and rupees 20,000 respectively. I will move on to the next section. Okay, profits of the partnership firm. Profits of the partnership firm. In general, whenever there is a profit earned by the firm, okay, what happens in the case of the profit earned situation? What happens in the firm? Let us see. First of all, one portion of the profits, one portion of the profit is kept aside, set aside as in the form of reserves. It is set aside, reserved in the firm in the form of reserves. It is called reserves. Reserved means set aside. And whatever is left over and above that, that only is the rest of the profits is allocated between the partners. So whatever profit is earned, we set aside a portion as reserves and the remaining is only allocated between the partners. That is allocated in different forms. One can be interest on capital. Interest on capital is paid to the partners for their capital contribution. Then we have salary to partners. Then we have even commission which we pay to partners. And then whatever is left after dividing all these things, that is only called share in profits. Okay, that is called share in profits. See just how the capital interest is paid to the partners. We charge from the partners something called interest on drawings. Okay, we charge to the partners. We get money from partners in the form of capital. The firm gets money from partners, so the firm pays interest on the funds. Similarly, when partners withdraw money from the firm, it is called drawings. On the drawings, the firm charges interest on drawings from the partners. I have put it in brackets because it is a negative amount. It is going to go out of the partners. It is charged to the partners account. It is not paid, it is taken from the partners. Okay, this is a new concept. So we will be first studying how to compute the interest on capital, salary, interest on drawings, commission and share of profits. For this, in this process, we will also be learning about an account called profit and loss appropriation account. This is an account which is drawn up to divide the different components of the profit to the partners. You will take aside a portion for reserves, then you will pay interest on capital, salary, we will charge interest on drawings and then we'll finally divide the profit share among the various partners. So this is the account which is called profit and loss appropriation account, which is going to do all these divisions and allocations. Profit and loss appropriation account because it is the appropriation of profits. So the appropriation is also one term which is a new term which you have learned now. Allocation is also denoted as appropriation. Okay, we are dividing the profit among the partners. This is also called appropriation or allocation. Next section is on interest on capital. Okay, so in the case of a partnership firm, okay, the partners, suppose the partners are A, B and C. They contribute money which is called capital and this is put in the business and the business functions with this capital. Business buys goods, sells goods, business pays salary, so many expenditures are there, business incurs other expenses also and then the business finally earns a profit. Now the partnership firm is earning profit. Now partnership firm uses the funds of the partners, okay, which is called capital contribution. So partnership firm earns money against the capital which is given by the partners. What has happened here is the partners, suppose they put in say 50,000 each money. Okay, they put in 50. So totally they have placed 1,50,000 as capital contribution. What happens is, if these partners, instead of putting the money in the partnership firm, if they had gone to a bank, say for example, if they had gone to a bank, they would have earned something like 4.75% or 5% or 6% as interest. If they had put this money as an FD, for example. If they had not put it as FD, if they had kept as savings also, even in that case, they would have earned some profit of some interest of around say 3% or 3.5% depending on the bank. So naturally, the partners would demand something from the firm as an interest, right? They would go back to the firm and they would say, please give me interest on my capital which I have invested. If I had not invested it in you, I would have gone to the bank and I would have earned some additional money over my capital. Now the firm, in turn, what does the firm do? The firm will reply, the firm will retort that I am anyway giving you profit. At the end of the year, I am paying you profit for the amount which you have invested. So why are you additionally asking me for interest on capital? Is this not enough for you? Am I not giving you money? Am I not paying you profits? Now the business is also justified. But the truth of the matter is that what is profit? Students, profit is the premium or the reward for risk taking. Profit is the premium or reward for risk taking which is undertaken by the partners. In any business, in any kind of business, there is an element of risk involved. If I do any activity, there is a risk that I will lose my money. There is a risk that I will not earn money or lose my money. So the partners are giving their money to the firm as capital, asking it to freely use the money, right? And the business earns money against the capital. Without capital, how would you function? How would the firm function? So even though the partners are asking for interest and then the firm says that I'm giving you profit, the firm is not justified because profit is the premium or reward for risk taking. They are giving the money even though there is a risk that the money might be lost. They are giving the money and therefore they are getting the reward as profit. Okay, that is not for the contribution of capital by the partners. It is for the contribution of the money as a risk taking situation. So therefore the truth of the matter is that partners are entitled to get interest on capital. Therefore interest on capital is to be provided from profits by business to the owners. Okay, so here there is a popular exam question which can be asked. Okay, I'll make a note here. Please note down this question. Okay, this is exam question. Why is interest on capital provided to owners when profits are also provided? When profits are provided, this means when you are giving them profit, why do you need to give them interest on capital? So the answer, the solution for that question is profit. Profit is premium for risk taking, whereas interest on capital is on amount invested. Whereas interest on capital is on amount invested. Therefore interest is to be provided from profits by business to owners. Okay, make a note of this. Risk taking, whereas interest on capital is on amount invested. Therefore interest is to be provided apart from profits. Apart from profits. Here also make a note of it. Apart from profits by business to owners. That means even it's over and above the profit that you give, you have to give interest also. The next section is about computation of interest on capital. So how do you calculate the interest on capital is what we are going to learn. So interest on capital is primarily, first of all, you will calculate it on opening capital, you will get the interest on capital on the opening capital and on the proportionate amount of additional capital. So what you have to do is, first you have to take the opening capital, calculate the interest on the opening, then take the additional capital which is contributed if it is there in the question, and proportionately do it on the additional capital also. That would give me the total interest on capital figure. Okay, let me take one question and I'll help you do it through this question. Mr. Amar has capital of 3 lakhs on 1/4/2018. During 2018-19, he invested rupees 2 lakhs on 30th September 2018. So precise date of investment is 30th September 2018. Find the interest on capital at 10% per annum. So the opening capital is 3 lakhs. Okay, on 3 lakhs we have to calculate the interest, and for the additional capital we have to calculate from the date of the investment. Okay, so on opening capital, it would be 3 lakhs into 10% per annum. It's per annum into 10%. This 3 lakhs is there for the whole year, so you have to take it as 10% itself. So this is 30,000. On additional capital, now this additional capital of 2 lakhs, let us see what has happened in this case. Additional capital of 2 lakhs has come on 30th September 18. So for how many months has this additional capital been? Now always in case of company, partnership, etc., we have to take the financial year. So 1/4/2018 they have said. That means the year runs from 1/4/2018 to 31st March 2019. That means we have 12 months in this period. Now instead of having it on opening balance, instead of investing it in the beginning, they are investing the additional amount on 30th September. So from 30th September 18 to 31st March 19. From 1st April 18 to 30th September 18, they have only 3 lakhs. From 30th September 18 to 31st March 19, they have additionally invested 2 lakhs. Okay. So either you take it as 3 lakhs for the whole year and 2 lakhs for the additional period, or you can take it as 3 lakhs for the first period and additional amount is taken as 3 plus 2, 5 lakhs. Okay, so I will go in for the second method. So this capital of 2 lakhs has been contributed on 30th September. So from 30th September 18 to 31st March, closing is 31st March 19. During this period, they have invested 2 lakhs. So this 2 lakhs has been there in the firm for the period 30th September to 31st March. How many months do we have? 30th September means end of the month. So you cannot consider September. October, November, December, Jan, Feb and March. So it is 6 months. 6 months it has been in the firm. So 2 lakhs into 10%, it is proportionately. So into 6 by 12. That would give me 10,000. So the amount of additional capital interest is 10,000. The total amount is 40,000, which is the interest on capital. So my answer is interest on capital is 40,000. Here if you see, from 1st April 18 to 31st March 19, I have with me 3 lakhs. And from 30th September 18 to 31st March 19, I have with me 2 lakhs. So the total capital I have is 5 lakhs, which is divided in the above manner. So this I have taken for full 12 months and this I have taken for 6 months. This is how I compute my interest on capital. First you have mind clarity and you do it slowly. Questions. Okay, in this chapter, capital on 31st March 17, X is 5 lakhs, Y is 3 lakhs. Okay, then they say that during the year 2016-17, profits of the firm were rupees 2 lakhs. Profit was rupees 2 lakhs. Additional capital contributed on 31st December 2016 was as follows. X was rupees 2 lakh and Y was rupees 50,000. So additional capital was contributed on 31st December 2016. See, the dates are very important. Okay, dates are very important. X was 2 lakhs and Y was 50,000. Then drawings during the year, X was 50,000, Y was 40,000. Find interest on capital at 10% per annum for the year 2016-17. This is the question. Find the interest. Now understand the sequence here. First of all, the year has to be identified. It is 16-17. It is 1st of April 2016 to 31st of March 2017. This is the year. This is the financial year. If I draw a timeline, the first step for me is to draw a timeline and understand the financial year and the sequence of events. This is year 2016-17. Now on 1st April, business opening period. On 31st March 17, they are giving you capitals. They are giving you capital. X is 5 lakhs and Y is 3 lakhs. We don't know what is the capital on 1st April 2016 for both X and Y. And the additional capital was contributed on 31st December. Here it is in the middle here. 31st December 2016 additional capital was contributed as 2 lakhs and 50,000. Okay, this is the additional capital. I know that my closing capital of both partners will be, first I would have taken the opening capital. I also would have considered the additional capital. What else gets added? Additional capital gets added to the opening balance of capital, and then the profits of the year get added. The profits of the year get added to the business capital, and then the drawings gets deducted. Drawings gets deducted. So if I need to find the opening capital, I have to take my closing capital minus the additional capital minus profit plus drawing. If I want to find out, see, I know that the closing capital is opening capital plus additional capital plus profit minus drawings. Profit is getting added to the capital, drawings gets deducted from the capital. If I want to compute the opening capital, I keep it on this side. I take my closing capital, I subtract the additional capital, I subtract the profit, and I add back the drawings. So let me do for both X and Y, I will do based on the drawings and the additional capital and the profit. Now the profit of the firm is 2 lakhs. Profit of the firm is 2 lakhs. There is nothing mentioned on how to share the profit. There is nothing mentioned on how to share the profit, means you share it equally. So X gets 1 lakh and Y gets 1 lakh. Okay, and then the drawings is there. It is given clearly X is 50,000 and Y is 40,000. So let us do the equation and we will calculate. Okay, so I will do my calculations here. X is closing capital, which is 2 lakhs plus additional minus additional capital. Additional capital of X is, now here I'll write down here additional capital. So it is minus 2 lakhs plus drawings, which is 50,000 minus profit of 1 lakh. Okay, and this is closing is 5 lakh. So 5 lakh minus 2 lakh plus 50,000 minus 1 lakh. So I'll again repeat it for the benefit of those who have still not understood. It doesn't matter. Once more I'll explain. Slowly I'll explain. You are given the closing capital, you are given the drawings, you are given the additional capital and the profit. Profit ratio is not given, so you are dividing it as 1 lakh and 1 lakh for the partners. Drawings is divided and given, closing is given, additional is given per partner. You have to compute the opening capital using the relationship closing is equal to opening plus additional plus profit minus drawing. Therefore, opening is equal to closing minus additional minus profit minus plus drawing. So, closing of X is 5 lakh, additional of X is 2 lakh, profit share of X is 1 lakh, I deduct that, and my drawings of X is 50,000. So, I get 2.50. So 2,50,000 is X's opening capital. Similarly, for Y, it is 3 lakhs minus closing capital. Okay, closing capital is 3 lakhs minus additional capital. Additional capital is 50,000. Add the drawings 40,000. Subtract the share of profit. So this gives me 1,90,000. So we have to calculate separately, and then for Y we have to calculate separately. For X, first we have to take the opening capital and calculate the interest on capital at the rate of 10%. They are giving you to take it as 10%. Opening capital of X is 2,50,000 into 10%. It is there for the whole year, so you take it as 10%. Total of X, additional capital contribution of X is 2 lakh on 31st December 2016. 2 lakh into 10% into number of months the capital is there in the firm. From December 31st, December there is no date available, so Jan, Feb and March. Okay, so 3 months is the period of interest into 3 by 12. This gives me 25,000 and this gives me 5,000. So the total interest on capital for X is 30,000. On the opening capital, opening capital of Y is calculated at 1,90,000. So 1,90,000 into 10 by 100. It is there for the whole year, so you just have to take it as it is for 12 months, 19,000. Then the additional capital of Y. Additional capital of Y is 50,000. So this additional capital is 50,000 into 10% into same 3 by 12. That gives me 1,250. So the total capital, interest on capital is 20,250. See, make a note here. Okay, just make a note here. Since profit sharing ratio not given, distribute equally. Make a note of this point. This is for you to get a guidance on how the profit sharing ratio has been determined. Since the profit sharing ratio is not given, distribute equally.